Have you ever wondered how investors can make money when a stock price goes down? Let us break down the mechanics of short selling. Short selling is a trading strategy that bets on the decline of a specific stock price. The risk profile is unique. While a standard stock purchase is limited to your initial investment, shorting carries significant and potentially unlimited risk. Investors borrow shares from their broker, sell them immediately, and hope to buy them back later at a lower price to return the loan. Most investors go long, meaning they own the asset. Shorting is essentially the reverse process of traditional investing. If you sell at $100 and buy back at $80, you pocket the difference as profit, minus any borrowing fees. Because of the high risk involved, many experts suggest beginners stick to long-term strategies rather than speculating on price drops. Understanding these mechanics helps you read the market more effectively. Thanks for watching, and remember to keep learning about how markets operate.